Welcome to the deep dive. If you feel like you're drowning in information but still aren't sure what really matters, well, you're in the right place. We cut through the noise to give you clear, actionable knowledge. Think of us as your shortcut to being genuinely well-informed. Today, we're tackling something that sounds kind of technical but is actually fundamental. Sales and purchases inside a computerized accounting system. We're going to demystify how these systems work, how they streamline everything, and give businesses, those crucial real-time insights. And to make it really clear, we'll follow a simple transaction. We've got two sole traders, Farida, who sells pet accessories B2B, and Pierre, a pet shop owner who buys from her. We'll see this whole thing play out from both their perspectives.
Exactly. And just to set the stage for this deep dive, we're keeping it focused, really zeroing in on the core stuff. So how a sale or purchase gets initially recorded, and then what happens when the money actually changes hands, the receipt or the payment. We're deliberately leaving out things like sales tax or returns or, any balances carried over from last year. Just pure clarity on the basics for now.
Okay, good plan. So let's dive in. I think the biggest thing to grasp up front is that modern accounting just assumes everyone uses a computerized system, right? And crucially, that sales and purchases are integrated, not separate processes anymore.
That's the absolute key word, integrated. It means when one thing happens, like recording a sale, a whole bunch of different records get updated automatically, like instantly. All at once. It's a huge leap from, the old days of manual books where you'd write it here, then copy it over there, maybe forget something.
Lots of room for error, I imagine.
Oh, absolutely. This simultaneous update is fundamental. It changes everything, speed, accuracy, even how you track things for audits.
Okay, so let's get specific with our example. It's January 1st, 20x1. Pierre orders 100 dog collars from Farida. They're $5 each, so that's $500 total. And Farida gives him 60 days credit. Good customer.
Right. Standard terms for a trusted relationship. Payment isn't due immediately.
So let's put ourselves in Farida's office first. She's the seller. She gets the order, packs the collars, ships them off with a delivery note. But the really interesting bit for us, the deep dive moment, is when she generates the sales invoice in her accounting software. What actually happens then?
Okay, so when she hits generate invoice or whatever the button is, her system does more than just, spit out a PDF. It performs two critical actions at the exact same time. One, it creates the actual invoice document for Pierre, and two, it instantly updates her own internal accounting records.
Right. And which records are we talking about? What gets changed inside her system?
Good question. Primarily, it updates her main financial record book, the general ledger. Specifically, two accounts in there. Her revenue account goes up, showing she's earned income, and her trade receivables account also goes up. That's the account tracking money owed to her by customers.
Okay, trade receivables like an IOU tracker for all customers combined.
Exactly. But crucially, it also updates Pierre's specific customer account within her system. She might have a code for him, like you mentioned, PPS 101. So she knows the total receivables, but also exactly how much of that total is owed by Pierre.
Got it. So the system is doing the bookkeeping automatically. It's making what accountants call a journal entry, right? Debiting one thing, crediting another.
Precisely. Behind the scenes, invisible to Farida, maybe the system records.
Yeah.
Debit trade receivables, $500. Credit revenue, $500.
And in plain English, what does that debit and credit actually signify for her business right then?
Okay, think of it like this. The debited trade receivables is the system saying, hey, we now have an asset worth $500. It's the right to receive cash from Pierre. It increases what's owed to the business. And the credit to revenue is the system saying, we've earned $500 in sales. That increases the income, which eventually flows into her profit calculation. It's just the system's language for recording both sides of the event. And this brings up a really important point. Why track both the total trade receivables and Pierre's individual account, that PPS 101? Why the extra layer of detail?
Well, I guess knowing the total amount owed is one thing, but you need to know who owes it, right? For actually getting paid.
Exactly that. Farida needs to manage her cash flow. She needs to know if Pierre is nearing his payment deadline or if maybe he's consistently late. That individual account, sometimes called a subsidiary ledger account, is vital for managing that customer relationship, chasing payments if needed, maybe deciding whether to offer credit again in the future.
Yeah, it makes sense. You can't just look at the big total number.
Right. It's practical business management, not just bean counting.
Okay, so let's jump ahead. Pierre's a good customer. He pays up on January 15th, well within the 60 days. How does Farida's system handle that incoming $500?
So Farida gets the payment, maybe it's a bank transfer. She goes into her system, records the receipt, and crucially, she matches it against that specific $500 invoice she sent to Pierre. The moment she does that, boom, another automatic journal entry happens.
What does that one look like?
This time is debit bank $500 because cash has come into her bank account, increasing that asset. And credit trade receivables, $500. This reduces the amount owed to her.
So it cancels out the earlier debit to trade receivables related to that invoice.
Precisely. The overall trade receivables balance goes down by $500, her bank balance goes up by $500, and very importantly, Pierre's individual customer account, PRS 101, is updated to show a zero balance. He's all paid up for that transaction.
Okay, crystal clear from Farida's side. Now let's flip the coin, as you said. Same transaction, but now we're looking through Pierre's eyes. For him, Farida's sales invoice is his purchase invoice. What happens when he gets that piece of paper or maybe email and enters it into his accounting system?
It really is like looking in a mirror. When Pierre inputs the details from Farida's invoice into his system, it triggers a similar but opposite set of automatic updates in his financial records.
Okay, so which accounts get hit on Pierre's side?
His general ledger gets updated too. This time, it affects his purchases account that tracks the cost of goods he's bought to resell or use. And it affects his trade payables account. That's the flip side of receivables. It tracks money he owes to suppliers.
Trade payables. So his list of IOUs to other businesses.
Exactly. And just like Farida tracked Pierre individually, Pierre's system updates Farida's individual supplier account. He might have a code for her, like F8421 you mentioned. So he knows his total debt to all suppliers, but also exactly how much he owes Farida specifically.
So it's fascinating how it mirrors Farida's entries. When Pierre enters that invoice, his system automatically makes a journal entry too.
Absolutely. His system records. Debit purchases $500. This increases the recorded cost of the goods he's bought. Think of it as an expense or inventory cost hitting his books. And it credits trade payables $500. This increases the amount he owes to suppliers, establishing that debt to Farida.
So his purchases go up, showing he bought stuff, and his payables go up, showing he owes money for it. It balances perfectly, just like on Farida's side.
Exactly right. A perfect mirror image.
And that individual supplier account for Farida, F8421, in Pierre's system, I assume that's just as critical for him.
Oh, definitely. Just like Farida needs to know who owes her, Pierre needs to know who he owes and when. It's crucial for managing his own cash flow, making sure he pays suppliers on time to keep those relationships good, maybe catch any early payment discounts that they're offered.
Right, you don't want to upset your key suppliers.
Not ever. So that individual tracking is essential for managing his outgoings effectively.
Okay, final step in the dance. January 15th arrives. Pierre sends the $500 payment to Farida. How does his system record that?
So Pierre initiates the payment and updates his accounting system to reflect it. He'll match the payment to Farida's invoice in his system. This triggers his final automatic journal entry for this transaction. Debit trade payables, $500.
Reducing the liability, the amount he owes?
Correct. It wipes out the $500 debt to Farida that was sitting in payables and credit bank $500 because cash has gone out of his bank account, reducing that asset.
So his debt to Farida is cleared, his bank balance reflects the payment, and her individual supplier account in his system goes back to zero for this invoice.
Precisely. The transaction is complete from both sides, all neatly recorded. His total purchases for the year still include that $500, of course, but the payment aspect is settled.
Wow. Okay, so when you walk through it step by step, it's actually quite logical. We've seen this single $500 transaction ripple through both Farida's and Pierre's systems automatically. So what's the big takeaway here? What does this integrated mirrored system really mean for businesses listening?
Well, what's really fascinating, I think, is the level of real-time visibility it provides. For both Farida and Pierre, it's not just about recording history anymore. It's about having an up-to-the-minute accurate picture of your financial position, who owes you, who you owe, how much cash you actually have. Think about Farida. She can see instantly if receivables are creeping up too high. Or Pierre can see exactly what his upcoming payment obligations are next week.
So it allows for much quicker decisions, more proactive management.
Exactly. It shifts things from reactive bookkeeping to proactive business management. You spot trends faster, you manage cash flow better, you make smarter decisions about credit or purchasing because the information is right there, instantly updated. It's less about just tracking numbers and more about using those numbers to run the business better.
And I suppose for anyone listening, understanding this basic mechanism is key. It shows how businesses keep things straight, manage their money, stay accurate, and how much of it is automated now. It removes so much manual work, reduces errors. It's like the hidden engine of commerce.
It really is. And yet we used a super simple example, one invoice, one payment. But these core principles, they scale up, add in sales tax, returns, discounts, multiple invoices. It gets more complex, sure. But the fundamental logic of these integrated automatic mirrored entries, that remains the same. It's all built on this foundation.
So to recap, we've really seen how one transaction sets off this chain reaction of automatic updates in both the buyer's and seller's systems, keeping everything perfectly synchronized.
And maybe a final thought to leave people with. Just think about the sheer volume of these transactions happening every single second globally, billions of them. Now consider how absolutely fundamental this automated, mirrored system of recording sales and purchases is. Without it, without this instant integrated structure, can you imagine the chaos, the errors, how slow and complex basic trade would be?
It's kind of mind-boggling when you think about it that way.
It really is. The efficiency and clarity these systems provide are just immense and often totally taken for granted.
A really powerful point. It certainly makes you appreciate the quiet elegance of double entry bookkeeping powered by modern tech. Thanks for breaking that down.
My pleasure.